Hey guys, there are two popular types of investing that people usually talk about. That is dividend investing and growth investing. Now these are two different types because they have two different focuses. Now today we're going to be talking about which gets you rich faster. Dividend ETFs versus growth ETF investing. Now you may be wondering which is the best for you, and that's what we're going to cover in this video. Hey guys, my name is Steve and I run the Frugal Expat website where we try to help people to save more and invest better. Today we're talking about which gets you rich faster. Dividend ETFs versus growth ETFs. Now you may be wondering why I'm talking about this, and that's because there's a lot of different types of people out there, and there's different risk tolerances versus different strategy ways of doing things. There are a lot of people that are my age that are looking at growing passive income through dividends. There are also people my age looking for growing their portfolios through the use of using growth ETFs. Now there are a lot of popular ETFs out there, and I have talked about them many times, but today we're going to be breaking down these two different approaches to help you figure out which one you may be looking at doing. And we'll also have some examples to show you guys what a great portfolio could look like. I hope this answers some of the questions you maybe have. All right, let's get to it. Now the two approaches do have some similarities. You're going to be getting rich. Investing for growth or growth ETFs is for getting rich. Investing into dividends is for living rich. There's two different ways to do it. Now, first of all, let's look at growth investing or growth ETF investing. Now, growth investing are investing into companies that are using their profits to grow, expand, innovate, create, and to make products to help it, grow. And you can see this with different companies like in tech. You can see it with biotech. You have all these great companies that have come out in the last 10, 15 years that are growing, expanding, and innovating for the future. Nvidia was a chip company that created chips for gaming and for lots of other things. And then they innovated and switched into AI. And now it's one of the most popular AI companies in the planet. So that is a way it's kind of went from growth and creating something and then innovating into a new industry. So those are some examples of some growth companies. Now, what are growth companies for? For people that are higher risk, that means they're going to have higher returns. But with the higher risk could mean that they could go belly up. They're not as stable. There's going to be a lot of volatility. Some days and some years, they're going to go down crazy. Some years, it's going to go up crazy. In 2022, the Nasdaq 100 was down 33%. And then in 2023, it was up 54%. So that means you're seeing that it can go down pretty quickly and it can go up. And so that has less stability and more volatility. That just means high risk, high return. Now, who is this good for? This is good for those that are looking for, they have a long-term investing horizon. They like high risk. And those that may be younger. Older people could have high risk as well, but these are probably suitable for, those young professionals that want to have those high risk returns and they have 20, 30, 40, 50 years left in their investing horizon, so then they can take some dips and turns. That's a little bit about some growth investing. Some popular growth ETFs that you may be looking into is first you have SEHG. SEHG is the Charles Schwab US Large Cap Growth ETF that tracks the Dow Jones US Growth Index. Now, this ETF has an expense ratio of 0.04%, which means it costs about $4 for every $10,000. It has about $42 billion assets under management, so it's a pretty big ETF that a lot of people continue to invest in. It's got a very low share price of about $26 to $27, and it has averaged about 17.88% over the last 5 years. So that's pretty good if you're looking for some good growth. SEHG has a low price, it's got a low expense ratio, and it's averaged about 17.88% for the last 5 years. So if you're looking for something that's got a lot of different growth in it and it's got some good diversification, SEHG is a great one. Our next one's going to be QQQM. Now QQQM is the Invesco QQQM Trust, which tracks the Nasdaq 100. It is the little brother to QQQ, which it's the same thing except it's a little bit cheaper. The expense ratio is 0.15%, which means it costs about $15 for every $10,000 invested. Now, this is the top 100 companies in the Nasdaq 100 that are non-financials, and these are growth companies and some consumer staples like Costco. Costco's in there, PepsiCo's in there, but then you also have Apple, Nvidia, Microsoft, Meta. You have some great companies in this ETF. Now, this ETF does have about $50 billion in assets under management, and over the last 5 years, it's averaged about 17.45%. Well, QQQ has averaged about 17.45%, but QQQM QQQM is the same index. It's just a little bit cheaper. All right. So this is a great growth ETF that you could add to your portfolio. If you don't pick SEHG, well, QQQM is a great one. And most people are picking QQQ or QQQM, but SEHG is also a great one. So these are two great growth ETFs that you could add to your portfolio. Our next ETF is going to be VGT. Now, VGT is a little bit different. It's a Vanguard Information Technology ETF. So it tracks a lot of tech. Now, it's not very diversified because it primarily holds tech, but it holds small caps, mid caps, and large caps. And the top three is Apple, Microsoft, and Nvidia, which makes up about 46% of the ETF. So it's a little bit tech heavy. Now, this ETF does have about $99 billion in assets under management with an expense ratio of 0.09%, which means it costs about $9 for every $10,000 invested. Now, it's had a 5-year annual average of about 19.18%. So it is by far the best performing out of these three, but it's also less diversified and higher risk. So that's just some things to think about. The higher risk means higher reward. And it's also got a lot of money in about 3 different companies. So that's some things to think about. I like VGT, I like QQQM, and SEHG, but that's just me. All right, let's get on to some dividend ETF investing or dividend investing. Now, dividend investing is all about investing to live rich. So you are looking for that passive income that is coming in each and every month, each and every year, each and every quarter. It's that rolling income that you're expecting from dividends. Now, dividends are basically profits from the companies that are being shared to the shareholders in the form of a dividend. So they have extra money, and instead of investing for growth, they are sharing it as a dividend. Now, there are popular growth companies like Apple, Microsoft, and even Nvidia are paying dividends, but that's just besides it. Now, there are companies like Coca-Cola, PepsiCo. There are companies like JP Morgan that have been paying dividends year upon year for maybe 25, 50. Some have been paying dividends for a very long time. And these are giving the shareholders that hold them just a piece of that profit. Now, these companies and dividend investors are looking for stability. They're looking for those companies that have been around a long time and that have a little bit lower risk. These are companies that are stable. They generate a lot of cash. They have a lower risk. You'll see these in utilities, consumer staples. You'll see these in healthcare. So these people are looking for these. Could be those that are looking for passive income. They could be those that are maybe retired. They could be those that are people getting close to retirement. Maybe they're 10, 15, 20 years out and they're looking for creating steady and reliable income for their retirement. And like I said, in those looking for passive income. So that could be me. That's like bouncing off and creating a lot of passive income. So maybe in a couple years, I don't have to worry about my job. I can live off those dividend incomes. That could be a person that would want a dividend investing strategy. So some great dividend ETFs that you can look at is FDVV, which is the Fidelity High Dividend ETF. It's got a yield of about 2.97% with an expense ratio of 0.16%, which means it costs about $16 for every $10,000 invested. It's got about $2.38 billion in assets under management, so it's a newer ETF that's been around since January 2017. Now, it's got about 25% in tech and about 18 to 19% in financials. So that's a little bit more than a lot of these other ETFs that I'm going to talk about. Now, it's got a performance of about 17% annually for about the last 5 years, which is great. I mean, if you think about dividend ETFs, shouldn't be growing this fast, but FDVV does because it's got a high percentage of tech in the ETF. All right, our next one's going to be SPYD, which is the Spider S&P 500 High Dividend ETF. Now, it tracks the high dividend paying companies on the S&P 500. So it's got about 80 different holdings. It's got a yield of about 4.51%, and it's got an expense ratio of 0.07%, which means it costs about $7 for every $10,000 invested. Now, the assets under management are about $6.7 billion, and what makes this a little bit outstanding is it's got real estate and it's got utilities as some of the two top sectors. 24% of it is in real estate and 18% is in utilities, which is different than FDVV. All right, our next and last ETF that you should consider and look at is SEHD, which is the Charles Schwab US Dividend Equity ETF. Now, this tracks about 100 different holdings. It's got an expense ratio of 0.09%, 0.06%, which means it costs about $6 for every $10,000 invested. Now, it does have about $70 billion in assets under management. Now, it's got a 3.9% yield, and it's also got about 20% of its holdings in energy and about 19% of it in consumer staples. So each of these dividend ETFs are very different. One's got a lot of tech and financials, one has a lot of REITs and utilities, and one's got a lot of energy and consumer staples. So these are all three different ETFs. They all have a yield of over 3% and a pretty good performance, and it's also pretty cheap. So these are great ETFs. You can buy and hold and get a lot of great dividends from it. Now, what strategy is great for you? Is it dividends or is it growth? Now, you may not be on the all dividends side of things or the all growth side of things. You may be a mix of both. That is kind of like me. You know, I like to have a little of a core like a VOO or VTI and add some growth like QQQM and some VGT with some dividends like SEHD to kind of create a great portfolio for me. And so then I have a lot of growth, and I also have some stable income with also a core, so then when things go abrupt, I still have a good stable portfolio that can help me go through. Now, it may be a little bit conservative or it may be a little bit too risky for some of you, and some of you may be looking at some different types of portfolios. So I decided to make maybe a more growth oriented portfolio and a more dividend oriented portfolio to see what are the outcomes and see what are some good things and some bad things. So my growth portfolio combines a broad market ETF like VTI, and so I put 50% into that. I then put about 35% into SEHG and 15% into VGT, and the results were pretty good. Over an 8-year period from 2017 all the way to now, it averaged about 16.61% annually for it. Now, it did have a dividend yield of about 0.88%, and the max drawdown of this portfolio was negative 25%. So there was a time when it dropped all the way down to 25%, but of course it rebounded and had a great return overall. Now, this is a great portfolio that can grow your money, but it doesn't have those dividends because it's only got a dividend yield of 0.88%, but it could be a great growth portfolio for the long term. Now, if you're looking more into dividends and you wanted kind of a piece of all three of those dividend ETFs, I also made one of those portfolios. Now, I took SEHD, making it like my core, so I put 34% in it. I also put 33% into FDVV and 33% into SPYD. Now, these three are kind of different in each one. One's got more tech and one's got more energy. One's got more REITs and utilities. And so it was a combination of all three that I thought would be possibly a good portfolio. Now, it averaged about 10% annually for those last 8 years with a dividend yield of about 3.91%. Now, that is a great dividend yield if you ask me. Now, if you wanted to see kind of the max drawdown or the farthest it came down in the negative was negative 3.91%. So if you're looking for stability, this ETF portfolio was very stable. I mean, you're talking about it only dropped down almost 4% in the whole time, which is pretty good compared to the one that's growth that dropped negative 25%. Now, it does have a performance that lags the growth, but it's also got a yield of about 3.91%. So it's continuing to create income for you. Now, each of these portfolios are different. Each of them has its own speciality. You have one that's focused on growth and one that's focused on dividends. So if you want one of these, you can pick it. You can also design it any way you want. But each investor is different and each one has a mindset they want. As for me, I want a little bit of income with a little bit of growth and a little bit of stability. And so that's how I'm growing it. I want to get my income to be rich and also have some passive income coming on the side with my dividends. So that's a little bit about me, and that's a little bit about how I design my 3-fund portfolio. So if you want to see what a good 3-fund portfolio is, I'm going to leave a link up here so you guys can see what is a good 3-fund portfolio to make a framework for your portfolio. Let me know in the comments. Do you prefer dividend investing or growth investing? I'll see you guys in the comments. I'll see you in our next video. See you guys.